this last session. I was lucky enough to actually be in the car, and I had the live stream going on that Dave Tasker had set up. So there's some interesting prospects for you all. I'm sure a couple of you have already identified a couple. Umberto has been keeping me up to date on one that he thinks is got some great potential. So I've slipped that into my ones to keep an eye on, but we're going to see a couple more this afternoon as well. Now, I believe that Mr. Peter kept both the chair and the microphone well and truly primed. Everyone was on time. We came out on time, which I said, are you sure you were at the right conference? But apparently that is correct. Everyone was on time. We had time for questions and we got outside on time. So apparently the stakes are higher for this particular session because at 5 o'clock we're going outside and Stewie is putting on drinks for us. So we need to be out of here at 5 o'clock. So I will be very brutal with the time, boys. At 12 minutes, I will ring my bell. At 13 minutes, I'll stand up, and at 15 minutes, I'll be pushing off the side of the stage. And there's no stairs on that side. You may have noticed, boys, correct? Yeah, it's a bit like that. So we've got an hour and a quarter up our sleeve for this session. It is jam-packed. We've got some great presenters. We're going to start with these two fellows up here. This is an energy company that we haven't had the pleasure of seeing on this side of our Great Wall for the last few years. Emperor Energy, actually there's a little synergy there with the name, Emperor. I call our head that, don't they? Emperor Energy. They're a good little company with a good little story, and they're opening the final session of day one and taking to the stage here at RIU, Good Oil and Gas. To explain the who and the what for us, we have something a little bit different. We've got a double act. We've got directors Carl Dumbrell. Would you put your hand up, please, Carl? And Phil McNamara. So the who and the what we're going to find out from these two guys, because there's been a lot of interest in junior energy companies of late. EMP is certainly on trend in that field. So we're really looking forward to hearing from you two in person at last to see what EMP has to offer us in 2022 and beyond. Would you please make them welcome?
Okay, thank you. I will be brief as Phil's here to do the technical, but I'm here to just give you an update on who EMP is and where we sit in the world at the moment. As said, we haven't been able to be here since, I think, 2019. I presented in front of you guys, but we've done an amazing amount of work in that time frame. We bought new seismic. We processed that seismic. We're the first ones to do that in the Gippsland Basin. We're doing a lot of work at the moment with AGR, who are here, and Andy's in the room, hopefully. So I'll give you a quick update on that, who the team is. We're all here, whole team's here. We'd really encourage you guys to come and have a detailed chat with us so that today or tomorrow out there and run through where we're at with our project, because the next 18 months are going to be really exciting. So just to kick off, standard legal disclaimer. I have lodged this morning with the ASX, so if you want a copy of this, just jump on the ASX website and I'll get it on our company website this afternoon as well. Very quickly, who the team is. So Phil's on stage with me here. He's the good looking one. And Phil was CEO of Emperor Energy when it founded years ago now. I brought him back into EMP when I got involved. He's a mining engineer and he's one of the smartest people I know. So you're going to get a lot of knowledge out of Phil in a minute. I'm a chartered accountant. I was brought into this company by major investors who are the biggest sponsors here today. So to Jeff in New York, who's hopefully watching, John Hancock, and to Martin Rogers, look, you know, you've been great supporters of our company and we look forward to that ongoing support that you give us. We've then got Nigel Harvey, who's our independent director. Jeff Geary's here and in the room. Jeff's great to talk to about this. He's worked in the Bass Strait forever. And Malcolm King is a great supporter, and Malcolm's up the back there. Malcolm was on the well in 1989 when they drilled it, so he's worth a chat if you want to have a look at our thing. Our advisors are in the room as well, and I'll give Paul Harley of Hopewell Gammon a mention. And other than that, guys, have a look at our shares. They're cheap. We're all skin in the game. I've got 6% of the company personally. Phil's got a lot. Other than that, Phil, you've got 13 minutes to do your magic.
Thanks, Carl. Thanks, everyone. We run a very flat structure at Emperor Energy. One thing I will say, though, is Carl is company secretary and also in control of the finance. He brings the company a very, very safe pair of hands. Very important in a junior company like this. Now, I'm going to take you through essentially our key project, which is the Judith gas field in Bass Strait, offshore Gippsland. This is the permit, Vic P47. We're focused on the Judith structure in the south, and the Judith 1 gas discovery well was drilled in 1989. A long trend here to the west is Long Tom, that's been in production, and the more recent Southeast Long Tom gas discovery. Up here is the Orbis gas plant, was owned by APA. We had dealings with APA. It's been sold to Cooper Energy. Logically, we'd be starting to commence discussions with Cooper. This is an image from the older seismic data that we had. This is just gives you a perspective of the structural configuration across to the west from Judith and around Kipper. Here's the Judith structure, the Rosedale Fault. Over here is Long Tom and Southeast Long Tom. All three structures, anticlinal features from east-west compression, and all sealed up against the Rosedale Fault. And here's the producing Kipper gas field. It's 15 kilometres from Judith 1, sorry, 5 kilometres from Judith 1 to Kipper, and 15 across to Long Tom. Long Tom's the key analogue for us in what we're doing here. It provides us with a lot of data. It's the same formation. We've got stratigraphic correlation across there. Just an overview of what this looks like. We have a 1.8 TCF P50 prospective resource. Initially, 1.2 TCF in the Judith and Long Tom gas sands, which are lower down in the formation, and with the recently acquired seismic, we identified another play further up in the Kipper and the Golden Beach gas sands, and from there, earlier this year, we released a 600 BCF prospective resource upgrade. There's also an existing 150 BCF 2C contingent resource around the original Judith 1 well. The project's de-risked. There's already a gas discovery in place in 1989 from the Judith 1 well. We've reworked all of the data that's available very intensively across a few years. And we were fortunate enough to have CGG carry out a regional seismic acquisition in 2020. That was underwritten by Exxon. And we've purchased a license to the seismic that sits above sits over the Judith gas field. That's given us far better interpretation and also allowed us to run AVO analysis and get some very positive AVO response. Judith's on trend, directly analogous to the Long Tom and Southeast Long Tom gas fields. All the gas that's come out of Long Tom and sampling from Southeast Long Tom have been very, very low CO2. Long Tom, in a horizontal well that was drilled for production, was tested at 75 million feet per day. It peaked at 90 as the well was first turned on. We see a clear path to production of 80 million feet per day across a 25-year period. That's across, I'll go through that in more detail, but across a 4-well production field. We've got a front-end engineering design or a pre-feasibility study that was completed with APA for pipeline to the onshore crossing, gas plant, feed into the Eastern Gas Pipeline, and delivery to the whole of the East Coast. We're close to Melbourne and Sydney. I see a lot of stuff about delivering to the East Coast, but most of that is from the north. This is a prime location. The Judith 2 appraisal well, we're looking to drill that at the back end of next year to define reserves. Right now, we're actively looking and have been looking and continuing to talk to parties about getting a major farm-in partner to fund the well and prove these reserves. And as I said, we're very, very well positioned to get into the very, very lucrative East Coast market. Some more detail here of this image is from the newer seismic. You can see the Judith 1 well here. It's drilled on a rollover. It's very flat where it was drilled, down closer to what we think is a gas water contact. And we're focusing the Judith 2 appraisal well further up dip, 500 meters up dip in the structure. This is the work program that's filed with NOPTA. We're on target here. We've been ticking the boxes. We're in this phase at the moment. We're preparing the application for approval to drill the well, and we are planning to submit that application this year. We've just got to do our final reviews on where we're up to. AGR are our partner on that work, and they're preparing the application for us with a series of subcontractors. So next well is next year is the scheduled work program for the well. So this little bit of geology. This is the Admiral group here, the Emperor subgroup here. That's where the name of the company. We changed the company name to Emperor because of the focus on this resource. And the Golden Beach Kipper subgroup up above here is where we've put in the additional prospective resource this year. Some correlation from Long Tom at the west across to Judith. You can see that the gas-bearing formations thicken as we come to the east. And one of the things that when I first started to get involved in this, and I looked at what had come out of Long Tom, we realised that the gas producing sands at Long Tom had never been penetrated in the Judith 1 well. So that provides a really major upside for this appraisal well, is to penetrate the Long Tom sands, as we call them, down here, not previously penetrated at Judith 1. However, they are included in the prospective resource. Some petrophysics. We've redone some work here. We've looked at the breakout in the original borehole. There was a lot of overbreak. The caliper graph there shows a lot of breakout. And we've recently done some work and analysis of this well, Judith, versus newer wells that have been drilled in the same formations, and done some adjustments, corrections to the gas saturation level. So we're very confident that we've got gas saturations from 40 through to 60%. And here's the gas saturations over here. The total net pay of gas sands, 162 meters, and average porosities 12 to 13%. This is some of the new seismic. So this shows the Judith 1 well. The red zones here are the gas-bearing sands. You can see this seismic line's running from Judith along strike and then up dip over here. And we can see the extension of these gas sands from Judith going to the west. This seismic's totally changed our ability to interpret this structure. It's very, very good. Jeff Geary's our geologist. Come and talk to him if you like. He's been through this in very, very fine detail. We've got a very, very good handle on what's happening in this structure. Down here is the Long Tom gas sands, and you can see the extension of them underneath the Judith 1 well, and then further across to the west as we go across strike. We did AVO analysis of the new seismic. This shows the top of the Judith gas sand 2. This is on the flat area where Judith 1 is. The AVO's stronger because the reflection's better on a flat surface than on the steeply dipping area further up the structure. And the original seismic that we had just didn't give us much response because of the steep dips and the fact that geophone tails just don't pick that up as well. But you can see that the AVO response extends right across here up into the structure. Judith 2 is focused or targeted in here in the middle of this major block. This is Long Tom, just some information about it. This is the only production that's ever come out of these sands, but we can see here the 77 million feet per day from the horizontal well. Long time produced over a period of years. It had technical problems with electrical controls at the wellheads, and then ended up being blocked out of the Orbis gas plant as the plant was sold and changed hands. This is a little bit about the Kipper and Golden Beach play. This is higher up in the structure. Once again, AVO response. This is where we've got a more recent 600 BCF prospective resource. This is some production modelling that was done in detail. 4 production wells giving us a sustained production rate of 80 million feet per day across 25 years plus. I like to convert that into electricity. It's the equivalent of one of the really big gensets at Eraring or Bayswater Power Station in New South Wales. It's a continuous 550 megawatts of electricity equivalent. And the East Coast gas demand, what's happening? So this is out of AEMO's latest report. This is what's planned and in place. This is what's planned to come from the north. This is anticipated. We sit in here somewhere, and this is what is anticipated as LNG imports, probably into Wollongong, which is just not happening at this point. And this is the size of the shortfall. It's getting bigger and bigger. The appraisal well, I've got 1 minute to go. This is the target, the Judith 2 location. This is why we're getting in here up dip from the original well. What we're trying to achieve is prove up more contingent resource and get to the minimum economic threshold for the capital investment required, demonstrate the producibility of the reservoir with a DST, explore the underlying long-form sands, and appraise this upper Kipper Golden Beach play that we've identified. 1 well, that's what we're planning to drill, 25 million US. AGR are our well management partner. They're doing the well design, they're doing the well approval now, and we'll continue to move forward with them. Thank you. Oh, right on time. How's that?
Good on you. Well done, Phil.
You were coming
Coming at you, Phil. That was it. Well done. Great presentation. And good to have you both back. Go and chat to them and chat to all their mates out the back there and hear more. Thanks so much, fellas. Thanks for opening up this particular section. All right. Good on you. Next up on the stage at RIU Good Oil and Gas, explorer Invictus Energy has been rating towards the top of the energy sector, according to recent news reports. They're based here in Perth. They're exploring in Africa. Scott Macmillan is the managing director and founder. Can you welcome him, please? He joins us to cover off on everything from, do you know what? You can talk about your numerous drilling projects. Let's make him welcome and give him that full 15 minutes.
Thank you, Chrissy, and great to be back at Good Oil once again this year. Invictus has been around since 2018, when we first came on the scene with our Kabora Bassa project, which is located in the north of Zimbabwe. It's an area that was previously explored by Mobil in the early 1990s. They spent a huge amount of money there shooting 2D seismic, gravity, aeromag, and geochem. Their conclusion was that the basin was more likely to be gas prone as opposed to oil prone. They were out hunting big oil targets. However, there was no structured market for gas in the region, and so they relinquished it. Coupled with the above ground difficult investment environment at in the latter half of the Mugabe era, and also the fact that Mobil had never made any of this data public, meant that this opportunity sat unknown about until we picked it up. We've matured it over the last 4 years, and we are at the cusp of beginning a really high impact drilling campaign, probably one of the biggest that the ASX has seen for some time. Our first well, Makuyu 1, will spud probably within the next 7 days or so. It is an absolutely enormous target, 20 trillion cubic feet and 845 million barrels of condensate. So 4.3 billion barrels of oil equivalent, all in the one target, all being drilled in Makuyu 1. So a huge, enormous prize. We've just consolidated our position in the basin and now have a basin master position. We cover the entire conventional oil and gas play fairway. We've picked up through a deal with the Sovereign Wealth Fund, access now to another very exciting area in the basin margin, which we think has similarities to the prolific East African Rift System and the String of Pearls play. And I'll take you through both of these very exciting targets in a second. We've just recently completed a capital raise to fund our drilling program. So we're funded for 2 wells, and that will be drilling 11 targets across those 2 wells. So a very, very different drilling campaign to what people are used to. More recently, we've also brought in a carbon offset project, and we will be the first carbon neutral cradle to grave project and also company. So a very key differentiator as well of Invictus, not only with a fantastic world-class exploration portfolio, but also carbon neutral from the outset. We've got a fantastic market to sell into in the event of success in our exploration program. We've got gas sale MOUs with existing customers in Zimbabwe and a very hungry regional market, great infrastructure to move it to market. And finally, we've got a very experienced board, not only from an oil and gas perspective, but also with Zimbabwean DNA. Looking at where our project is in the region, we have Special Grant 4571 and now EPOs 1849 and 1848 as a result of this consolidation. We've been surrounded by activity by some fairly major players, but as I mentioned, the above ground environment over the latter half of the Mugabe era meant that Zimbabwe was uninvestable. Fortunately, now with the new government, that's changed. They brought in investor-friendly reforms, and through our unique competitive advantage, being Zimbabwe dominant, you can probably tell from my accent that I am from Zimbabwe. We've got a lot of experience there. My family's still based there, so we do know our way around. We've been surrounded by activity, but Invictus has the first mover advantage. So our prospect and lead portfolio. We've got a fantastic portfolio now with enormous potential and fantastic running room. That means that in the event of success, we control the entire basin, the whole play fairway. And that means that the follow-on and the likely success that will come out of this, if we do, and if we are lucky enough to make 1 or 2 discoveries, means that Zimbabwe and the rest of the region will have a big dent made in the energy deficit, but Invictus will be a very, very different looking company. So our first well, Mukuyu 1, is targeting this enormous big 4-way anticline in the basin center, we call the central fairway play. We've got 6 prospects and leads in this play. Mukuyu is the first one that we'll test. It's a 200 square kilometer anticline, the largest undrilled structure in onshore Africa. Baobab, the second well that we'll be drilling, is along this basin margin area. And this is the so-called String of Pearls play. And we've got the basin bounding fault here in gray, and you can see these prospects sitting along it, which form this little string of pearls. These are quite big features in their own right. Baobab's about 18 square kilometers, but next to Mukuyu, it does look fairly modest. So Baobab will be the second well that will spud. And that, again, if that's successful, provides us with running room for the rest of these prospects. So a very, very exciting drilling campaign ahead of us. Looking at Mukuyu, the first target, that is 7 stacked targets in that first well that we'll be drilling across those horizons, and Baobab 3 to 4 stacked targets. So Mukuyu in a little bit more detail. This is a very, very simple schematic of the prospect. These are the 7 targets that we'll be drilling through. We've got 2 major hole sections of interest. The 12.25 will drill through 200, the post Andy, and TD at the base of the forest. We'll then wireline log that section. That'll take roughly 25 to 30 days to get the first results for that whole section. We'll then drill out to our primary target, which is in the upper Angwa, and total drilling time estimated around 50 days. This is Exala's Rig 202, which is currently on site. That's the Mukuyu well site. We're about to start drilling. As I mentioned, we'll probably spud within the next 7 days or so, and that'll be the commencement of a very exciting few months ahead of us with Mukuyu and Baobab. Looking at the 200 horizon, which is the very first target that we'll be intersecting, this has been something that's matured from the seismic campaign that we shot last year, the CB21 survey. We've got some very encouraging signs from the seismic. We've got amplitude shutoffs across the structure, both in strike and dip. Those are just two random lines across there. And we've got conformance of the amplitude when we extract that conforms to structure, potentially a 300 or 400 meter column in this first target. So something very material that's very exciting as a first up drill target, albeit our primary target is at the very base in the 500, sorry, I beg your pardon, the 650 and 600 in the upper Angua, which is the Triassic source. So we'll be drilling this well on the backside of this fault, targeting some of these bright amplitudes in the 200. We've got some other very nice flat events through some of these other targets, and then down onto the 600 and 650 for Mukuyu 1. So the basin margin play. Baobab will be the second well that we'll drill in the sequence, looking at the southern area along the basin bounding fault. We've just got a snapshot here of 4 of these along here: Baobab on the left, Acacia, Marula, and Mimosa. These are all named after indigenous trees. And you can see that we've got this set up. This is the escarpment of the Rift Valley. These shoulders sit roughly 1,000 meters above the valley floor. So that is that basin bounding fault that you can see in blue along here for all of these prospects. And the compressional event that caused these huge big rollovers and foreways in the center of the basin also pressed up the sediment against the basin bounding fault and created these little rollovers and traps against them. So these look very, very similar to what we see further to the north in places like Kenya and Uganda, those prolific East African rift systems which have seen billions of barrels discovered. So it's a play that we've been very excited to mature. It's something that we identified when we reprocessed the original mobile data, and when we designed this CP21 survey. It was really to, beg your pardon, it was really to mature the drilling location for Mukuyu 1, but also provide us with better coverage across the basin margin play. So we're thrilled that we've taken this from a conceptual exploration play that we recognized from further north and now matured it into a really fantastic portfolio. The independent prospective resource for the string of pearls is in progress, and that'll be released to the market as soon as it's signed off. Looking at Baobab in a little more detail, this is at the 200. You can see these little rollovers through here, which form these traps against the basin bounding fault. This is the source interval through here. This is unique in the basin margin area. It on-naps onto the big anticline further north. The closure for Baobab at this 200 horizon, roughly 16 to 18 square kilometers of closure, fairly big, but again, not next to Mukuyu, which is a bit of a freak. So the comparison and why we really like this basin margin play, and something that we've been excited to release in the last week or so to the market. This is the Lokichar Basin in Kenya. So this is where Tullow and Africa Oil saw tremendous success in their drilling campaign in 2012. The string of pearls in the Lokichar, they've got their basin bounding fault that you can see in the light gray through here. And these green, these shaded green areas are the fields that have been discovered along that margin edge. Ngamia 1 was the play opener for that basin. This play fairway is roughly 50 kilometers, and we're playing in about a 90-kilometer fairway through here. So in the Lokichar so far, roughly 800 million barrels discovered. Tremendous success rate, and again, why we like this basin and the potential of this basin margin is because of the repeatability of these prospects, and what we see in these string of pearls, very similar traps up against that basin bounding fault. I'm missing the Ngamia comparison, but if you go to our presentation on our website, which we released on Friday, you'll see the comparison between the Lokichar, the basin opener Ngamia that was drilled, the very similar seismic sections, as well as some other examples from Uganda in the Albertine Graben. So fantastic exploration portfolio, but from a market perspective, what are you going to do if you discover big gas or big amounts of liquid? So fortunately, where we are, although we are landlocked, I like to think of us as land linked. We are in the center of a very hungry energy market. And with the Southern Africa power pool that you can see the spine of in yellow, connects Cape Town all the way through to the Southern Congo as an electricity grid, and the spine of that all runs through Zimbabwe. We've got cross-border electricity trading that happens and is run out of Harare. And at the moment, we've got electricity that's exported to Namibia, imported from South Africa, and Zambia imports from South Africa, and all of that runs through Zimbabwe. So we've got the greatest access to that regional network of electricity. We're 100 kilometers away from from 3 major interconnectors, which means that monetizing gas now is a much simpler proposition. Gas by wire into a very hungry regional market will be a very elegant solution for us and enables us to monetize big volumes of gas. Furthermore, we've already got a gas sale MOU with Sable Chemicals, a fertilizer manufacturer in Zimbabwe. They are currently importing gas by rail from South Africa. The onshore fields in Mozambique that were discovered in the early 50s and 60s, but were only developed in the 2000s, are fairly mature. And that is the sole source of gas in South Africa at the moment. So that's dwindling. The energy crisis on the east coast of Australia and Europe is unfortunately being something that's been experienced in Southern Africa for at least the last decade and is getting worse. Premium pricing in these markets and a very, very hungry and dependent economy on gas. We've got other options as well. Small-scale LNG for some of the off-grid miners who burn diesel. A lot of that diesel comes in via these pipelines. So we've got electricity grids, we've got pipelines, and we've got fertilizer as some of the major markets to monetize any volumes that we find. South Africa facing an extreme power deficit within the next 5 to 10 years. 20% of their grid is being brought offline. It's retiring coal-fired power, and that has no replacement in sight. So through the Southern Africa power pool, we can service the major industrial hub in South Africa through that electricity grid. And then finally, our carbon offset project, which we brought in a few months ago. We've been very active and proactive on this front. We recognize that the world is decarbonizing, and companies need to have a plan in place to ensure that they can get the requisite funding, the support from the investment community, and also their regional government. So this project was awarded through a tender process. It will ensure that we generate excess carbon offsets that will be in excess of what we require to offset our own emissions. So we'll be cradle to grave carbon neutral. The excess credits will be sold in on the voluntary market. And this is actually a really nice separate business arm for us, but ensures that we're on the front foot in this respect, and very, very good looking forward pricing curve for carbon offsets as well. Just to wrap up, we've got a basin master position in the Cabora Bassa. We'll be carbon neutral, cradle to grave, fantastic infrastructure and markets at premium prices to monetize any discoveries, a very supportive government. We've got a very experienced board and management team and a lot of skin in the game. All of our directors sit in the top 10. Low cost onshore. We've got a very exciting 2-well program ahead of us, which will kick off in the next 7 days.
Fantastic. Thanks, Scott. Thank you so much. Right. Tamboran Resources has a focused strategy on developing approximately 31 TCF of prospective gas resources from the Beetaloo sub-basin in the Northern Territory. And due to the low in situ CO2 content of Beetaloo gas, and very quickly, so I don't take up your time, they're planning to achieve net zero scope 1 and 2 emissions from the commencement of production. So joining us to talk about how learnings from the US shale industry will play a vital role in unlocking the Beetaloo sub-basin with potential to support Australia's energy transition and our national energy security. Would you please make welcome this fella up here? They call him Mr. Beetaloo. They only let him out occasionally, but he's out here to talk to you, some select investors. David Close, would you please make him welcome, everyone?
Thank you very much for the introduction, and yeah, thank you for the invitation to be here. Excellent to be talking about the Beetaloo and representing the Northern Territory over here at Good Oil and talking to you today. I'll dive in. We will have some forward-looking statements and be making some predictions. None of you will be surprised by that. And I'll talk briefly about the company and then a little bit about the opportunity and introduce those of you who aren't familiar with the Beetaloo to the Beetaloo sub-basin as we go along. share some similarity with some of the projects we've heard about today in terms of being relatively early stage. But I think what probably differentiates is the scale that we're talking about. It's unconventional shale play. And the age, for the geologists out there, it's pretty unique in that it's a Proterozoic shale. So a very different target than most oil and gas plays. So about Tamboran, this summarises Tamboran's vision about being to be a net zero producer from day one. So similar to a lot of companies that have a greenfield blank canvas, we can plan for that from day one, which allows the efficiencies that you'd expect from a modern development to be able to take advantage of that. Very much focused on the Beetaloo. So we're bringing in the North American expertise, combining with a good understanding and knowledge of Australian operations to bring the combination of the best of both worlds, focused in the Beetaloo, focused in these unconventional shale plays of Northern Territory. Good assets, and really trying to, like I said, leverage that unconventional expertise to bring cost of development down and supply substantial volumes and really be a game changer in terms of volumes into the East Coast and or export market. So a little bit about the company. This is on our website. So if you've got curiosity, find me afterwards. You'll see there that we were listed about last July. So relatively young, held by some very knowledgeable North American investors and a lot of the directors and board as well as you'd expect. So the vision really is to go from exploration to scale development, because we need that scale to get costs down. This is the type of play where you do need to have volume of opportunity to be able to get down the cost curve. We know there's a lot of gas in the Beetaloo. It's really around the economics of the extraction and the market's price. So we see that in the near term, we'll be able to convert a substantial amount of contingent resource with the right pipeline agreements, with the right commercialization agreements, and that will provide the springboard to scale it up into the sort of export scale that we can underpin. We will not be supply limited. If there are economic molecules here, there will be economic molecules to supply east or north to expand to support the Northern Territory Middle Arm Sustainable Development Precinct. There is not a supply limit. We're talking about tens to hundreds of TCF if we can get across that economic threshold. And we'll talk a little bit about why we're more confident about that based on the results from the last year or so. So there's not enough maps and sections in here. I feel a bit embarrassed that other people have had more geology than me. But there is one map, and this is showing the depth, approximate depth down to the Valkyrie B shale. So the Valkyrie is the Proterozoic marine source rock. Very important that it's a marine source rock that's analogous to successful shale plays in North America, Canada, Argentina, and very different to, say, the source rocks in the Bowen Basin, the Cooper Basin. So this depth window, you get everything from about 1,000 meters down to greater than 3,000 meters. So we have a range of maturities, we have a range of depth windows. And over the past decade, since Falcon Oil and Gas tested the Shenandoah 1A well and proved gas to surface from Shenandoah 1A, we've seen a number of really important wells. First was the Amungi NW1H well. Origin flowed that in 2016 initially. Some positive, a good technical proof of concept. But when they turned it back on in 21 and ran a PLT, they saw that almost all the production was coming from only 4 or 5 stages. So if you have 1 million and a bit a day coming from 4 or 5 stages, it's very different than 1 million and a bit coming from 10 plus stages. So that's an important result. More recently, the Tamboran 2H and 3H wells, they've just run their production tubing. We've made some ASX releases over the last few days, upgrading resources and showing that we're now much closer to that economic threshold and beyond, arguably, that economic threshold of about 3 million scuffs per day per 1,000 meters. So there's some important timing right now as we sit here and watch Tamboran move ahead with the Maverick 1H well, which is offsetting those Tamboran, those Santos wells. And to the east of this map, we'll hear more from Alex tomorrow and the results they've got at their Carpentaria wells, that Empire Energy have got at the Carpentaria wells. So some really important results that after waiting 9 years almost for some of us who've been working the basin up here to start getting these catalysts, these results to give us a bit of momentum and go to that next stage. So EP136 is the 100% owned Tamboran asset where we've been targeting drilling the Maverick 1H well with activity kicking off late May. We've effectively completed the civils works. The rig is almost ready to spud and we expect to spud next week. Water bores in place and all the other things you need to operate in the Northern Territory. I was going to say remote Northern Territory. It's probably a poor word. It's remote from some services, certainly. Mobilisation is at the moment, more challenging than it is in the Perth Basin or the Bowen or the Cooper. But it's actually next to some very major highways. It's next to a major train line. It's next to gas pipelines that connect you to both the East Coast and Darwin. So despite when we look on the map, it looks like the middle of nowhere. It's a pretty well connected part of Australia that could supply different markets. And I'll talk a little bit more about that in a minute. So what these wells will lead to, or the initial well will lead to with Maverick, is an increase in the contingent resource. That with some strategic drilling in the area between the Santos operated EP161 project with the Tamboran 2H and 3H wells, and our drilling on Maverick, expect to be able to scale up to multi-TCF contingent resource that you'd expect to convert with pipeline agreements. And I think we've heard a lot about the market today. People are hungry for gas agreements at the moment, and the price point that we've been running our economic models on for the last 6 years, 7 years, trying to get down below that, $7 Wallumbilla mark that we expected in the long term. I think everybody's taking a long, hard look at those numbers again, which is helpful obviously for frontier projects. A little bit about the wells. To date, there hasn't been a longer lateral, well, substantially longer lateral than a kilometre. The Carpentaria well was the first well to do substantially more than about 10 stages. Really what we see is the maximum efficiency from when you can do longer wells. So you get more reservoir contact with the same amount of surface effort and vertical drilling effort, and you stage your fracs appropriately to maximize your overall EUR per well. So over time, we'll expect to get rigs that can drill up to 3,000 metre laterals that we can then put 50 plus stages in and emulate the types of plays like the Marcellus in the US, where it's not unusual to have 20 plus BCF per well. The resource here, like I said at the start, is hard to get the head around. It's of a scale that no other onshore play in Australia is really in the same realm. I mean, there are some really frontier plays like Canning and South Nicholson Basin, but the Beetaloo with the Valkyrie in particular is this multi-tens of TCF resource. We're talking about over 18,000 square kilometres of prospective fairway with a target of over 50 metres in the main target, and then secondary and tertiary targets that are 20 to 40 metres thick as well. So we expect that in a success case, you can convert a large amount. But if we look at just a relatively modest conversion, I mean, they're big numbers, but in terms of the overall supply stack, a relatively small number, we see step changes being possible in this type of environment. And Empire, Santos, Origin, and ourselves, Tamboran, are looking at trying to really commercialize and push forward. And we think we've got an advantage of being able to move quickly and really seeking to race to market to take advantage of the current tailwinds in the current situation. I won't go through all of this slide. Like I said, it's on the website, and we released it to ASX, but a bunch of green lights in the last 12 months. Some really key wells that have been drilled by Empire in terms of drilling, proving there's no real technical limit to the length of wells we're going to be able to drill. The 161 and EP98, that's Santos and Origin operated wells that have both exceeded that critical threshold of 3 million a day per 1,000 metres. And some other key catalysts around cost and infrastructure that we see being really important. So it's had a rough start in some respects. The moratorium did slow things down for a few years, but the NT government are fully committed to implementing all the recommendations of the Pepper inquiry by the end of this year, and really see the tailwinds kick in and the operations be able to ramp up from next year. Now, it's difficult to make predictions when you haven't seen enough type curves to really know what your EUR per well is. But we think in a success case where we emulate the types of plays that we see in North America, and we see those efficiencies improve over time and that EUR per well improve over time. And again, even getting a representative number is difficult. If you go and look at a North American data set, it moves over time. So the mean is not representative. You need to be looking at specific subsets and seeing how it changes over time. And like I said in the Marcellus, it's not unusual to have 20 plus BCF EUR per well. That's become the standard now for the operators in the core of the Marcellus. So you can create very big wells, and they can be drilled really efficiently and put online very quickly. And that's why you see a lot of the US majors pulling back to places like West Texas, where you can really implement that kind of cash generating machine. So the estimates of costs here show that if we can get our wellhead cost down to that, $1 to $3, depending on the scale of your project, you're going to be right in the money for LNG export. domestic markets in the Northern Territory and or the East Coast markets for the various things that we obviously critically need gas for on the East Coast of Australia. And where does that look compared to the international supply stack? Because that's the obvious question. You need to be top decile. You need to be the best projects. There is competition out there for capital. People are looking at places that are advantaged for various reasons. We have advantage in Australia because we're building LNG infrastructure for decades. Countries like Canada are still trying to get their first LNG export projects off the ground. The US came late, obviously came pretty hard to the party, but they did come late. But Australia does have some existing structural advantages, including out of Darwin, out of Northern Australia, our distance to market. So our cost of supply, we expect to be really globally competitive if we're in the success path following the E&A activities of the coming couple of years. Well, I actually came in ahead of time. It's because I talk too fast. So look, I've even got time for questions, or I've got you back on beer o'clock.
Did you have a question, or are you up for beer o'clock? Which one would you like? Which option is your preferred one?
Everyone likes
They're going for beer. They want to talk to you over a beer, and I can't blame them, because that's when loose lips, we might, give them a little bit more. Good on you. Thanks so much. Good to have you up here. Thank you. Mr. Beadaloo caught me on the hop then. I was so busy looking at all the different little bits and pieces there and how we compared. I wasn't looking up. Right. Elixir Energy. And they're with us in the flesh as well for the first time in a few years. MD Neil Young joining us. And he's looking forward to regaling us with their 3 key projects, building on a very large coal seam gas project, which is in Mongolia, also green hydrogen in the same region. And more recently, they've actually come a little bit closer to home. Would you please welcome back Managing Director Neil Young.
Thanks, and glad to be back here in the flesh, first time since 2019. And I'll now talk about our 3 projects. Last time it was only 1, but like a mother with her children, I love them all. So our foundation asset, 100% owned coal seam gas asset in Mongolia called Nomgon. Driven by location next door to the world's largest energy importer in China. We have a highly experienced coal seam gas team, and upcoming shortly is an extended pilot production test, the first in the country, and hopefully successful to demonstrate commerciality. Building upon our more than 10 years experience in Mongolia, we have developed a green hydrogen project. We're now partnering with Japan's 2nd largest company, SoftBank Group. Proximity to market here is even more critical for hydrogen than it is for CH4. The wind and solar resources are fabulous, and we plan a pilot in the next year or so to again demonstrate commerciality. So some themes across these. More recently, we acquired a gas project in Queensland. Again, it is 100% owned, which gives us a lot of optionality. We can access domestic and international markets very readily. The play is dominated by majors, if I can include Santos in that category, and we plan an appraisal well for next year. So here's a capital structure and board. We're reasonably well resourced in terms of cash, more than 20 million at the last quarterly report date. Market cap about 140 million. Now the team, pretty much well known to most of you, led by Richard Cotty, our chairman, one of the godfathers of coal seam gas in Queensland. Significant experience in growing companies, with QGC being the primary example. The second godfather of coal seam gas, Stephen Kellerman, not quite as well known to most of you, but those that do know, he's an absolute global guru in CSG. Not sure I'll call her the consigliere. Anna, I can see her in the back of the room. She comes from the opposite end of the Soviet Empire to Mongolia in the form of Belarus, worked in China, and obviously brings that experience of the region, which is invaluable for us. So our first asset, 100% owned production sharing contract focused on coal bed methane or coal seam gas in Mongolia. The team that you've seen mentioned, plus a technical team that sits behind the scenes, it's highly experienced. Australia remains the global capital of coal seam gas, and that technical background is been very, very useful in the frontier CSG exploration and appraisal that we've been doing. The location, as I keep coming back to, is absolutely vital, next door to the border. The infrastructure is actually pretty good, echoing what David said. This seems remote, but it isn't. There are roads, there are mines, there's electricity networks, there are border crossings, and all of those things allow access to markets in various forms. We commenced exploration in 2019, made a first discovery in the midst of COVID in 2020, and are now moving through an appraisal and accompanying exploration phases. So in 2020, we're doing 2 pilot production wells. The next few days should see their spud. We're doing quite a number of exploration and appraisal wells across the vast PSC, around 20 in total. We've shot seismic each and every year we've been here. It's very low cost for coal seam gas. We've been reinterpreting that and feeding the hopper of exploration wells. On the commercial side, we're working with governments on a generation project, but that's not our only option. We've looked at mini LNG and fertilizer, and ultimately, of course, exports is the true goal. So pilot projects due to commence shortly. We've constructed a pad. We've got ponds to handle water, facilities to handle gas flaring. And this, if it works, which hopefully it will in the next few months, will demonstrate commerciality in this first region. The production wells are pretty close by. They're not particularly deep. We've hired an international drilling company called Major, who operates in Mongolia on behalf of Rio Tinto to drill these wells. So water production hopefully start in a month or so, gas production hopefully pretty soon after that, commerciality hopefully soon after that. Can't give an exact time frame because this is the first one. So Gobi H2 is our trademarked green hydrogen project. Mongolia provides, again, proximity to the world's largest energy importer, exceptional renewable resources, and those are the key ingredients for green hydrogen. In our view, this makes it a tier 1 project globally. Now we're engaging with multiple stakeholders who we think are validating that. Project finance is anticipated for the pilot project, and the likes of the Asian Development Bank and the European Bank for Reconstruction and Development are very keen to participate in that. Concept was validated in June by the execution of an MOU with SP Energy, a subsidiary of SoftBank Group. And I've signed a few MOUs in my time, and I'm sure many of you have, and they're on a spectrum. There's one signing one with the government of Mongolia, and there's one signing one with a Japanese major company. And that was a very significant endorsement in my view. So our primary goal in the short term is to advance a pilot project. The advantage of this location is that we can scale this. If you're doing green hydrogen export from Australia, you're big or you're nothing, whereas we can scale this up. So again, I come back to location. We're beside the border. We're beside the Mongolian province, or Chinese province of Inner Mongolia, which produces more steel than all of Australia. And China, of course, produces more steel than the rest of the world. And steel, as an example, is a market that will need hydrogen if the government is to meet its targets of net zero by 2020. Hydrogen costs in Japan, in China, I saw a study this morning, are now in a region where they are lower than LNG spot prices and pretty close to LNG contract prices at $100 oil. So hydrogen is not only greenwashing, it is a real product. And I think that is demonstrated by the quality of partner that we've brought in. So delivery costs are what drive competitive advantage here. Hydrogen is very difficult to move. I mean, we all know that methane's expensive to move, say $4 or $5 to ship it from Australia to China. To ship hydrogen to China would cost you $20. To ship it from Mongolia would cost you $2. So that's a competitive advantage, which we think is enormous. SoftBank Energy, I'll come back to that. We're a small company. Why have they partnered with us? We have been working in the country for over a decade, as have they. We have mutually trusted Mongolian partners, and that's culminated in the execution of an MOU back in June. They operate a wind farm in the country. It's world-class in terms of its wind resources. When they told me how good it was, I fell off my seat. It's better than anything but the best wind farm in Australia. They bring fantastic advantages to us. They're very experienced in working in China. Under the MOU, their job is to engage with customers. Clearly, they bring a massive balance sheet, and they bring huge capability in terms of taking assets to where they're most valued on exchanges and other markets around the world for capital. So our new asset ATP 2044, located above the Taroom Trough, a Permian feature in the Southern Bowen Basin in Queensland. Again, to repeat myself, I come back to the key concept in gas of location, and this is proximate to the Wallumbilla hub, which means it can access domestic markets to the south and international markets to the north readily. Gladstone is very unusual in the Western world in that it has spare liquefaction capacity. That's not the case in North America. It is the case in Western Australia, but I think any new gas coming to that from Browse would take 10 years if you're lucky. As I said, the primary targets are Permian age sandstones and coals, so this is a deep, unconventional play. Going back to location, not only do we have access to, through existing infrastructure to Wallumbilla Hub and hence north, south and west, but also there is a proposed pipeline called the Hunter Pipeline, which Santos purchased recently, which effectively goes through the Taroom Trough, where coincidentally, I don't think so, Santos has some acreage, goes through Narrabri to East Coast markets. So ESG is probably a nasty word in this room, but I think we all have to recognize that if you want to actually develop a project, you need large-scale capital, and large-scale capital does take notice of this and needs to take account of it. And I've quoted Fatah Birol, but equally I could have quoted Ben van Beurden because the themes are the same. New wildcat assets will not be developed, be explored for and developed by majors. It will be proximate to discovered resources, preferably ones that can be turned off and on. And that's what this is. It's proximate to infrastructure, doesn't need major pipeline to be built, and its key capital costs are drilling wells, not building plant or platforms. The gas is low in CO2, so scope 1 and 2 emissions will be low. And also interestingly, from a blue hydrogen perspective, this is an emerging hub for CCS exploration, led by Glencore, but now with others joining, and I understand Origin will be one of them shortly. Blue hydrogen is just arm waving unless you've got reservoirs to put CO2 in, and this appears to have that capability in the Surat that overlaps the Bowen. So this is an area of existing discoveries. BG Group, now Shell, drilled around half a dozen wells 6 years ago. They flowed gas to surface in various quantities. Immediately to our west, they flowed 3.5 million a day through a well called Daydream 1. And our first appraisal well, Daydream 2, we plan to drill next year. In our view, fracking technology, as we heard earlier from Tamboran, has improved enormously in the last decade. We think the ability to get that flow rate and the EUR up significantly is very significant. The targets here are a very thick section, not only sands, but substantial coals as well. So that gives rise to substantial prospective resources and potentially contingent resources in the short term. The mean case is over 3 TCF. There is condensate in this play. We've taken a very conservative view of how much, but still come up with 75 million barrels. It could be considerably more than that. And that condensate could find a ready home in the refinery in Brisbane. So in summary on this asset, it's surrounded by majors as well as our friends from Omega Oil and Gas who have a stand here. We think the timing is perfect. This opportunistic acquisition is driven by what we think are enduring changes to gas markets driven by Putin. And I got a lovely quote there from Kevin Gallagher, which I'm tempted to quote in my Scottish accent, but I'll just say multi-TCF play, and bosses like that don't normally say that. So corporate highlights, first mover in Mongolia. We welcome our peers who've joined us. We want success for everybody. The experience in Queensland is success begets success. We've expanded our program year on year, and now we're undertaking a pilot this year. Balance sheet is strong. Our relationships in the country have been built over a long time, and those relationships underpinned our partnership with SoftBank on our Gobi H2 project. Going back to the Ukraine war, in my view, it's changed gas markets, not in the short term and the medium term, but in the long term. That means security of supply is valued strongly. That means if you're Chinese, you value Mongolian gas and hydrogen because it's secure. That means if you're Japanese or European, you value Australian gas because it's secure. And so we're playing to those themes via location, 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 security of supply, skills, and good deal making. Thank you.
Well done, Mr. Young. Thank you very much. So there is not a lot between us and Beer O'Clock team. Our last presenter today is also the sponsor of drinks this evening. So if you're leaving now, you will have a target on the back of your head, I would suggest, and it will read, "Do not serve this person beer." But if you are leaving us to get home, beat the traffic. Thank you for coming today. We look forward to seeing you tomorrow. All right, shall we get this last presentation underway, because it's going to be exciting. Argonaut Funds Management is finishing off day one of the conference. Now, primarily, yes, they invest in energy transition stocks, in renewables. So why are they here? They're here because, like most of you, all of you, they recognise that while the whole world is actually shifting to that renewables target for 2050, there is a runway between now and then, which includes oil and gas, and which they believe can be monetised. The question is why? Can you welcome this fellow up here, the man that's holding the purse strings for our drinks this evening, and is going to fill us full of information for our last talk, Argonaut ED and Fund Manager David Franklyn, up to answer that question. Welcome, David.
Thank you. Thank you, Chrissy. And thank you, everyone. Argonaut's been a long-term supporter of this conference, and we welcome you all here and look forward to being involved well into the future. So what I wanted to talk about today is really three things, but it really relates to how the oil and gas sector fits with decarbonisation and the energy transition that is underway. So firstly, as a professional investor, we look at the resource sector and we look at the energy sector, and really there's two key drivers of our business. One is the performance of the fund, and the second is how we grow funds under management so we can grow the size of our business. On the performance side, our strategy is focused on the long-term resilient themes, identify the commodities that are best placed to capitalise on those themes, and then target the best quality, best value companies that produce or can produce those commodities. And so that's what we're trying to do every day. On the other side of the scale is the growth in funds under management. And really that's partly driven by performance. It's also partly driven by robust and repeatable systems and processes, but it's also meeting the requirements of responsible investing, given that we're custodians of investors' money. And so when we look at oil and gas, there's a couple of factors we need to consider. So the first one is, realistically, oil and gas is ground zero for energy transition. Something like 42% of global CO2 emissions, direct and indirect, come from the oil and gas sector. If you look at the second chart, it also shows how global emissions by source and fuel type, and it also demonstrates that oil and gas is a big component of a lot of the major sectors there, from power generation to transport, etc. And I think you can look at that two ways. You can say this is catastrophic, or you can say what it shows is that gas in particular and oil they're efficient fuels, and they've got dominant positions in markets because they do it well. But investing in oil and gas means you need to be aware that transition is happening, and there's factors that are going to influence oil and gas investing, such as investor attitudes to climate change and decarbonisation are not going to go away. They're going to accelerate, and that's going to have implications for project financing and how you're going to be rated in the market. Oil and gas companies are also, to reduce emissions from oil and gas, you're either going to need to reduce demand or you're going to need to reduce emissions. And I think ultimately it'll be a combination of both. And that'll be through technology such as carbon capture, carbon offsets, etc. So having said all that, what's happened in the last 12 months? And the ASX 300 Resources Index includes all the resource companies in the ASX 300. The top 10 performers are listed here, and of the top 10, 6 are fossil fuels. So 3 coal companies, Whitehaven, New Hope, and Coronado, and 3 oil and gas companies, being Woodside, Karoon, Beach Energy, and Santos didn't miss the cut by too much. And I think what that highlights is a couple of things. One is energy transition is a transition. It's not going to happen overnight. And I think what we've seen is supply has been disrupted, firstly by a lack of investment, and secondly by Russia's invasion of Ukraine. Demand hasn't changed, and so you've had prices surge higher, and you've had these companies make a lot of money, both in the coal side and also in the oil and gas side. So what it shows is that when you're talking about energy transition and who are the commodities and who are the companies and the sectors that might benefit, in fact, you could argue that the oil and gas sector has been a big beneficiary so far. And I'd suggest that going forward, it'll also be an important component. So I just want to touch on the state of play in energy transition. So the first point I'll make is energy transition is happening and it's accelerating and it's not going away. So this first chart highlights that renewable energy sources are now cost competitive with coal and gas for new projects. And I'd suggest that their cost competitive is only going to increase as technologies improve, and also obviously while oil and gas prices are at the levels they're at now. Secondly, and again I'll just highlight here, I mean what this chart demonstrates is that a lot of investment is going into renewables, is going into solar and wind. You can see that coal power is in decline, and you know, if there's one commodity that's kind of the you know, taking the brunt, it's thermal coal. Gas is holding up pretty well, and I think that's because people are viewing it as an ongoing transition fuel. And probably the big disappointment on this chart is over here in battery storage, because if renewables is going to be effective, you need strong base load support for that, and batteries are pretty critical. So if thermal coal is the one that's taking all the heat over here, the standout from energy transition is really what's happening in EVs and transport, where you're seeing EV take-up continuing to rocket. I think in 2021, it was 6.6 million vehicles. That's forecast to be 40 million vehicles by 2030, and something like 60 to 80 million vehicles by 2040. So certainly the transition is underway. Similarly, funding for upstream oil and gas is falling in most parts of the world. The Middle East, probably for reasons that are obvious, is the region where that's different. But notwithstanding the transitions happening, it's happening slower than planned and really slower than it needs to happen. And I think it's worth just discussing that. So what I've got here is really a secure and affordable energy transition relies on large-scale take-up of investment in clean energy infrastructure. So if you're going to shift to electric vehicles and renewables, you need a lot of copper, you need a lot of lithium, you need a lot of nickel, and you need a lot of cobalt. And often those commodities are not easy to mine, they're not easy to find, and you know, and that needs to be borne in mind. So I'll just run through one example, and that is copper. So you can see the copper market 2021 is just over 20,000 kilotons or 20 million tons. So 2030 APS is announced pledged scenario. So what that means is it's the pledges that governments and companies have made to increase copper production as at today, which will come into place by 2030. And as you can see, with all those commodities, there's a good increase. It's a significant increase, and it demonstrates that the transition is underway. But the negative is the final bar there, 2030 NZE, and NZE is net zero emissions by 2050. So that's where it needs to be by 2030 to be on track to get to net zero by 2050. So you can see really across all those commodities, we're kind of doing pretty well, but we're not doing well enough. So I guess the way I see it is on climate change, current trends indicate that the world will fall short of its climate change targets if we keep doing what we're doing. On the mining side, the production of critical minerals and metals is falling behind required levels, and questions remain over the ability to ramp up mine production in a timely manner. And that's due to a whole range of factors. It can be regulation, it can be licenses, it can be the inability to find projects of scale and the right grade, etc. And then new technology, more broadly looking at energy transition. Again, we touched on battery technology. There needs to be more investment in that area, particularly for stationary batteries to support the renewables. Hydrogen technology or hydrogen will get there, I think, as a key energy source, but it's not there yet, and it's not cost competitive for the major markets. And nuclear is also interesting, where it's under consideration for broader adoption. But as you saw from the previous slide, it's still not getting a huge amount of investment. And I think, I read recently a comment on nuclear was, if it was invented today, you'd be seen as the savior of the global economy, because it's a carbon-free fuel source. But I think it's been around a long time, and people are aware of the potential risks as well as the upside. The other factor, which I think we're all very cognizant of at the moment, is geopolitical events can and will get in the way, both now and in the future. And we're not sure what they're all going to be, but they're going to be there and they're going to have an impact. So if you look at Russia, Ukraine, the implications there are really a realization that security of supply is paramount. What we're seeing rapidly now is degasification, LNG degasification facilities across the EU being put in place, new ones being built, floating capacity coming in. So what that says is that the EU contingency plan is LNG shipped in and provided, which highlights the importance of gas and to providing the power and to be a complement and a supplement to energy transition. I think they'll also consider nuclear. And also consider coal. And I think when it comes down to, are we going to keep our lights on? Are we going to keep our heaters on? Are we going to keep our industry going? As a short-term measure, they're certainly going to go with any option that they feel is necessary. There's continued momentum with new renewables, as we've seen, and I think that'll continue. But it is a transition that's not going to happen overnight. And then looking forward, there's other hotspots. If you look at what's happening in South America, which is really a big producer of the future-facing metals, copper, nickel, lithium, etc., there's social unrest in a lot of the countries. If you look at China, Taiwan, US, there's tensions there. Not really sure what the implications will be, but there's going to be implications for the energy sector. And political instability in parts of Africa, again, where they're very rich in resources. So I think these factors aren't going away. They're going to impact on the sector. So finally, I touched on this before. So if there's a key message, it's deal with demand before altering supply. And what we've seen over the last 12 months is exactly that. You had a drop-off in investment in fossil fuels because everyone's running off to future-facing metals. That was then exacerbated by the Russian supply constraints, and really, while green energy investment was growing, is probably not moving quite fast enough. So the implications of that was supply fell, demand stayed firm for oil and gas and other fossil fuels. Prices went through the roof, and now these companies are generating substantial profits. You can see from the chart here, really what this is showing is most places in the world are reducing expenditure on oil and gas, and the investment is going into green projects. So I think in summary, gas will play an important role in the transition. It's transportable, it's acceptable. It has lower emissions than coal, it's reliable, and it's profitable. I've got 2 minutes, so I'll run through these on pretty quickly. So what are some of the strategies that companies are running with? The first one is looking for resilient niche markets, and I think Cooper Energy is a good example of that. So what they've done is they've got high quality gas reserves. They've got ownership of processing facilities, and they're targeting a market that's in structural shortage with a combination of contracted volumes and spot sales into the Victorian market. We're a shareholder in Cooper, and we think it's got a good future. If you're looking at globally, what the big companies are doing, the big oil and gas companies, is they're diversifying and they're buying, green assets. So they're going green. You can see on the table there, investments in solar, electricity services, carbon capture, etc. Interestingly, on the hydrogen side, lots of people are looking at it, but out of those majors, but not a lot are devoting a whole lot of capital at this point. You've seen Woodside and Santos also move into carbon capture and consider hydrogen. So Warren Buffett, famous investor, he took a view that there's those companies that were out of favour with the market, lacked long-term growth potential, but generated strong cash flow. If they had a management team that was focused on repaying dividends and focused on shareholders, then it was a cigar butt that had a few more puffs left, where it doesn't have a long-term future, but would deliver good returns. And I think I see thermal coal as a bit like that, but I think there'll be opportunities in the sector for that. And finally, my final slide is BHP, where you can pass the parcel and exit the asset onto someone else. I better just show the final slide, which is our fund. Sorry, Chrissy. So
We can't go till you leave anyway, so that's all right.
So as you can see, the fund's been going for about 2.5 years, and we're very proud of how we performed. In financial year 2022, we're up 44%. We're up 125% in the last 2 years. And Australian Fund Monitors rated us the #1 Australian equity alternative fund and the #2 top performing fund across the 700 monitored funds that they look after. So we think we take a diligent approach. We invest only in resources and energy. About 15% of our portfolio is in oil and gas and energy at the moment, and we see that as a core part of what we do. But thank you, thanks for coming, and sorry to keep you from your drinks.
No. I've got a couple of questions that come through to me on the text line, so indulge us for 2 seconds. As I said, we can't go until you go because you're in charge of the beer anyway.
Yeah.
So question number 1 was, what are your preferred companies to invest in?
Yeah.
We turned off the feed now? We turned off the
Yeah.
feed. Yep.
So I'm assuming you're talking oil and gas, and energy. So the ones that we own is we own Cooper Energy, as we touched on. We also own Santos, and we have owned Woodside. At the moment, given how the market's been, we take a view that we want to be in the bigger end of the market rather than the smaller end of the market, given the uncertainty in financial markets at this point. So we're focused on producers rather than developers, but certainly, we see opportunity and we consider companies on their merits.
Okay, next one. Bearing in mind that Cooper's presentation is on tomorrow.
Yeah.
Okay. How is about our investors? How are our investors going investing with you?
How are you?
Our investors, are they investing in your fund? Our guys here?
Well, I hope they are. Yeah. So it's always a trade-off. So we see that we're trying to identify resilient long-term themes, right? And the resilient long-term theme is energy transition and the move away from fossil fuels to future-facing, to renewables and the future-facing commodities that support that. So that's our key driver. I think what we've learned over the last year is that it is a transition that's going to take time, and oil and gas is a core part of that. And there's still money to be made. You need to be selective, you need to be careful, and you need to be aware of the risks that are associated with investing in that area. But there's certainly opportunities as the last 12 months has shown.
Yeah. Thank you so much for that. I appreciate it. Cheers.
Yeah.
Would you put your hands together, please, for our final presentation today? We'll go and share a beer or two on you. That's very kind. We'll put your hands together for our sponsor for beer this evening. Now, before you leave, hold on a second. We start tomorrow morning at 10 minutes to 9. We've got a big program. We've had 11 presentations today. We've got 23 to get through tomorrow, and we intend to wrap up around 4 o'clock. Stewie has promised us the best sausage rolls in the world for the second day running. So I expect to see you all there, and I'm looking forward to having a chat with you outside and see what I missed out on in that first session to see if there's anything I should keep my eye on. Thanks, everyone. Cheers.